If you were born before 1955, there is a silent, completely legal trap actively siphoning money out of your Social Security checks right now. You worked 4, maybe 5 decades to earn this money, yet every single month, a massive portion of it is vanishing before it even hits your bank account. And the worst part is, the Social Security Administration will never send you a letter to warn you about it. Today, I am going to show you exactly what this drain is, why it is targeting your specific age group, and the one crucial step you must take to plug the leak before your next check arrives. I know how frustrating it is to feel like the rules are constantly changing beneath your feet, especially when it comes to the retirement you bled to build. You did everything right. You paid into the system with every single paycheck you ever earned, trusting the promise that this money would be there for you. But the rules governing Social Security are not designed to protect your wealth. They are designed to protect the system itself. Over the next few minutes, we are going to break down the exact mechanisms the government uses to claw back your benefits. We will cover the specific tax traps that trigger once you hit your 70s, the overlooked spousal rules that leave thousands of dollars on the table, and the hidden Medicare surcharges that eat your cost of living adjustments alive. My goal is simple: to give you back control of your money and protect your peace of mind. Let us start with one of the most heartbreaking mistakes I see people in your age bracket making, and it has to do with how the system handles the loss of a spouse. When a husband or wife passes away, the surviving spouse is often left dealing with unimaginable grief. The absolute last thing on their mind is calling the Social Security office to navigate a labyrinth of bureaucratic rules. But because of how the survivor benefit system is structured, failing to take immediate, specific action can cost a widow or widower tens of thousands of dollars over the remainder of their life. Here is how the system is supposed to work. When a spouse passes away, the surviving spouse is entitled to inherit the higher of the 2 Social Security checks. If the husband was receiving $2,500 a month and the wife was receiving $1,500 a month, the wife's check should step up to that $2,500 amount while her original, smaller check goes away. You get to keep the bigger check. It sounds simple and it sounds fair, but here is the trap that catches so many people born before 1955. Many assume this process is entirely automatic. They assume that because the government issues the death certificate and the Social Security Administration is notified, their next monthly deposit will automatically reflect the new higher survivor amount. In many cases, especially if you were already receiving spousal benefits on your partner's record, it might be. But in a staggering number of cases, particularly when both spouses were receiving their own independent retirement benefits based on their own work records, the transition is not automatic at all. You actually have to file an application for survivor benefits. Think about what happens if you do not know this. Month after month, you continue receiving your original smaller check. You are trying to pay the same property taxes, the same utility bills, and the same home maintenance costs, but now you are doing it on 1 income instead of 2, and you are not even receiving the maximum income you are legally entitled to. The government will not call you to remind you to apply. They will happily continue paying you the lower amount, and while Social Security does allow for retroactive payments, they only go back a maximum of 6 months. If you discover this error 2 or 3 years after your spouse has passed, that money is gone forever. You cannot get it back. But the survivor trap goes even deeper than just failing to apply. There is a massive oversight regarding when people claim their original benefits versus when they claim the survivor benefit. If you are in your 70s now, you might have claimed your own benefit early, perhaps at age 62. By doing that, you accepted a permanent reduction in your monthly check. However, if your spouse waited until their full retirement age, or even delayed until age 70 to claim their benefit, their check grew significantly. If they pass away, you are entitled to step up to their higher, delayed amount, even though you claimed your own benefits early. Your early claiming penalty does not carry over to your survivor benefit. Yet, I hear from people all the time who assume that because they filed early, they are locked into a lower tier forever, so they do not even bother investigating the survivor step-up. They leave hundreds of dollars a month sitting in the Treasury simply because they misunderstood a rule that the administration does a terrible job of explaining. If you have lost a spouse, or if you lose one in the future, you must directly contact the Social Security Administration and explicitly ask them to calculate your maximum survivor benefit. Never assume the check hitting your bank account is the correct one. Now let me ask you a question. Have you ever noticed that even when the government announces a cost of living adjustment, a COLA, your actual bank deposit barely seems to go up? You see the headlines proclaiming a 3% or 5% increase, but when you look at your checking account, you are only seeing a few extra dollars. This brings us to the second massive drain on your checks, and it specifically targets those born before 1955 because of the phase of life you are currently in. This is the phenomenon known as the tax torpedo, and it is entirely driven by a ghost from the 1980s. Back in 1983, the federal government realized Social Security was facing a funding crisis. To generate revenue, they passed a law stating that if a retiree's income crossed a certain threshold, a portion of their Social Security benefits would become subject to federal income tax. They established a metric called Provisional Income. To calculate your provisional income, you take half of your annual Social Security benefit and you add it to all of your other income. This includes your pension, your part-time job wages, your dividends, your interest from savings accounts, and crucially, withdrawals from your traditional individual retirement accounts or 401k plans. If you are a single filer and your provisional income crosses $25,000, up to 50% of your Social Security becomes taxable. If it crosses $34,000, up to 85% of your Social Security becomes taxable. If you are married filing jointly, the thresholds are $32,000 and $44,000. Here is the infuriating part. Do those numbers sound low to you? $32,000 for a married couple? They sound low because those thresholds were set in 1983, and Congress purposely chose never to index them for inflation. If those thresholds had been adjusted for inflation over the last 40 years, a married couple today would not pay a dime of tax on their Social Security until their combined provisional income was well over $90,000. But because the numbers were frozen in time, millions of middle-class retirees who are barely scraping by are suddenly finding themselves pushed into tax brackets where the government takes back a massive chunk of their benefit. Why is this hitting people born before 1955 right now? Because of the letters R, M, and D required minimum distributions. The government allowed you to defer taxes on your retirement accounts for decades. But once you hit your early 70s, specifically age 72, 73, or 75, depending on your exact birth year, the IRS decides they have waited long enough. They legally force you to start withdrawing a certain percentage of your pre-tax retirement accounts every single year, whether you need the money to live on or not. Consider this startling fact. An estimated 60% of retirees today are paying taxes on their Social Security benefits, a tax that was originally designed only for the ultra-wealthy. When you take that mandatory withdrawal from your IRA, that money is added directly to your provisional income. For a huge portion of seniors, that forced withdrawal acts as the exact trigger that pushes their provisional income over those ancient 1983 thresholds. Imagine you are living carefully on a fixed income. Your Social Security and a small pension cover your daily bills. You are not paying taxes on your Social Security because your income is just below the threshold. But then you turn 73. The IRS forces you to withdraw $10,000 from your IRA. You do not even spend the money. You just move it to a savings account. But because of the rules, that $10,000 pushes your provisional income over the cliff. Suddenly, not only do you owe income tax on the $10,000 IRA withdrawal, but now up to 85% of your Social Security benefits are added to your taxable income for the year. The government forced you to take your own money out of the bank, and as a penalty, they tax the Social Security benefits you worked 50 years to earn. This is the tax torpedo, and it drains thousands of dollars a year from retirees who do not see it coming. People end up having to withdraw even more money from their savings just to pay the taxes on their Social Security, which ironically generates even more taxable income, creating a vicious cycle of wealth depletion. The only way to fight this is through hyper-vigilant tax planning. This means communicating with a tax professional about exactly how much you can withdraw from your accounts each year without tripping the next tax threshold. It might mean considering Roth conversions earlier in retirement or utilizing qualified charitable distributions if you are charitably inclined, because money donated directly from your IRA to a charity satisfies your required minimum distribution without adding a single penny to your taxable provisional income. We have covered the Survivor Oversight and the Tax Torpedo, but what I am about to share with you next is the absolute biggest, most insidious drain on your monthly check. It is a completely hidden deduction that operates on a 2-year delay, and it specifically targets those of you pulling money from your retirement accounts or selling assets right now. It can wipe out your cost of living adjustment entirely and leave you with a smaller check than you had the year before. I will explain exactly how to stop it in just a moment. But first, we must address another critical misstep affecting millions of public servants born before 1955. If you spent your career as a teacher, a police officer, a firefighter, or a state or local government employee, you likely paid into a public pension system instead of Social Security for a large portion of your career. But perhaps you also worked in the private sector for a decade, or you ran a small side business, meaning you also earned enough credits to qualify for a Social Security benefit. You naturally expect to receive your full public pension and your full Social Security benefit. After all, you earned both of them separately. But there are two laws on the books that act as a massive, frustrating drain on your checks: the windfall elimination provision and the government pension offset. The windfall elimination provision, or WEP, reduces your own Social Security retirement benefit if you also receive a pension from a job where you did not pay Social Security taxes. The formula the government uses to calculate this reduction is incredibly complex, but the bottom line is that your Social Security check can be slashed by up to half the value of your pension, up to a certain maximum dollar limit. People are continually shocked when they finally retire, look at the estimated benefit they have been seeing on their Social Security statements for years, and realize the actual check they receive is hundreds of dollars less because the statement never factored in their public pension. But as bad as the WEP is, the government pension offset, or GPO, is significantly worse. The GPO applies to spousal and survivor benefits. If you're receiving a public pension from a job that did not pay into Social Security and you try to claim a spousal or survivor benefit based on your husband's or wife's work record, the GPO will reduce that spousal benefit by 2/3 of the amount of your government pension. Let me paint a very clear picture of how devastating this is. Imagine a woman who worked as a public school teacher for 30 years. She receives a teacher's pension of $3,000 a month. Her husband worked in the private sector his whole life and receives a Social Security benefit of $2,400 a month. When her husband passes away, under normal rules, the widow would step up and inherit his $2,400 check. But because of the government pension offset, the Social Security Administration takes 2/3 of her teacher's pension, which is $2,000, and subtracts it from the survivor benefit. Instead of receiving $2,400, her survivor check is reduced to just $400 a month. In many cases, the math results in the survivor benefit being completely wiped out, reduced to absolute zero. This feels like an incredible betrayal to public servants who dedicated their lives to their communities. They watched their spouse pay into the Social Security system for 40 years. Yet upon their death, the surviving spouse receives nothing from it simply because they chose a career in public service. If you fall into this category, you must plan your retirement and your surviving years with the full understanding that those spousal benefits will likely not be there to support you. You cannot rely on standard Social Security planning advice. You must calculate your future living expenses, assuming the GPO will drain that second check entirely. Now let us move to the ultimate silent drain, the trap that catches almost everyone off guard. Earlier, I asked why your bank deposits rarely reflect the official cost of living adjustments. The answer lies in how the government ties your health care to your Social Security. Most people know that Medicare Part B premiums are automatically deducted from your Social Security checks. Right now, a standard Medicare Part B premium is deducted every month before the money ever reaches your bank. When Social Security announces a cost of living adjustment, let's say a $50 increase to your monthly check, Medicare usually announces an increase to their Part B premiums at the exact same time. If Medicare raises their premium by $40 a month, that money is intercepted. Your net increase, the money you actually get to spend at the grocery store, is only $10. The government gave with one hand and took with the other. But the standard premium increase is not the trap. The trap is a little-known surcharge called IRMAA, the Income-Related Monthly Adjustment Amount. IRMAA is a surcharge added to your Medicare Part B and Part D premiums if your income goes over a certain threshold. But here is the most dangerous part of IRMAA, and the reason it specifically drains the checks of people in their 70s. It operates on a 2-year look-back period. When the government determines your Medicare premiums for the year 2026, they do not look at what you're earning right now. They look at the tax return you filed 2 years ago for the year 2024. They look at your modified adjusted gross income. If your income 2 years ago crossed their arbitrary threshold, they slap a massive surcharge onto your Medicare premiums today. Let's look at how this destroys the finances of people born before 1955. Let's say you are 75 years old. 2 years ago, when you were 73, you needed to replace the roof on your house. It cost $25,000. To pay for it, you took an extra $25,000 out of your traditional IRA. You paid the income taxes on that withdrawal at the time, and you thought the transaction was finished. But now, 2 years later, you receive a letter from the Social Security Administration. Because that roof repair spiked your income 2 years ago, you have triggered an IRMAA surcharge. Suddenly, the Medicare premium being deducted from your Social Security check jumps from a standard amount to double or even triple that amount. Your Social Security check, which you rely on to buy groceries and pay your utility bills today, is suddenly slashed by hundreds of dollars a month, all because you fixed your roof 2 years ago. And the IRMAA brackets are entirely unforgiving. They operate as a cliff. In normal tax brackets, if you go $1 over the limit, only that single dollar is taxed at the higher rate, not with IRMAA. If the IRMAA threshold is $103,000 and your income was exactly $103,000, you pay the standard premium. But if your income was $103,001, just one single dollar over the line, you fall off the cliff. You are hit with the entire surcharge for the whole year. That single dollar of extra income could end up costing you over $1,000 in extra Medicare premiums, automatically deducted from your Social Security checks. This happens constantly to people who sell a piece of real estate, people who take a large withdrawal to help a grandchild with college tuition, or people who are simply taking their required minimum distributions. They create a one-time spike in their income, and 2 years later, like a ghost, IRMAA appears and drains their Social Security checks. But there is a protective measure you can take, and this is the crucial step I mentioned at the very beginning of this video. The government will automatically apply the IRMAA surcharge, but they also have an appeals process that they rarely advertise. It is called Form SSA 44, the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. If your income has permanently dropped since that tax return 2 years ago due to a specific life-changing event, you do not have to pay the surcharge. The government lists several qualifying life-changing events, including the death of a spouse, marriage, divorce, or work stoppage. If you retired last year, your income right now is obviously much lower than it was 2 years ago when you were still working full-time. But the computer systems at Medicare do not know that. They only see the old tax return. If you do not file Form SSA 44 to prove you had a life-changing event, they will blindly drain your check based on your old salary. However, one-time capital gains, like selling a house or taking a large IRA withdrawal to fix a roof, generally do not count as life-changing events in the eyes of the government. This means the only way to avoid the IRMAA cliff in those situations is through meticulous multi-year tax planning. You must know exactly where the IRMAA cliffs are for the current tax year, and you must monitor every single dollar you withdraw from your pre-tax accounts, every capital gain you realize from selling stocks, and every bit of interest you earn. If you see that you are going to land just a few $100s over an IRMAA cliff, you need to find a way to reduce your taxable income before December 31st, perhaps by making a charitable donation or delaying a financial move until the next calendar year. Managing IRMAA is not a suggestion. It is a vital necessity for preserving the money you worked your entire life to save. You cannot afford to be passive with your retirement income. The system is designed to penalize the uninformed. Let's quickly review the massive financial leaks we have covered today so you can fortify your accounts immediately. First, we discussed the devastating Survivor Benefit Oversight. Never assume that the death of a spouse automatically triggers the correct maximum benefit deposit. You must actively contact the Social Security Administration, understand how early filing penalties do not carry over to survivor benefits, and formally demand that they calculate your step-up amount. Second, we exposed the Tax Torpedo, the completely outdated 1983 tax thresholds that cause up to 85% of your Social Security to be taxed the moment you start taking your required minimum distributions. You must work with a tax professional to manage your provisional income, utilizing strategies like Roth conversions or qualified charitable distributions to keep your income below the cliff. Third, we highlighted the heartbreaking reality of the windfall elimination provision and the government pension offset for our public servants. If you have a pension from a job that did not pay into Social Security, you must plan your future with the harsh reality that your spousal and survivor benefits may be completely wiped out by the GPO. And finally, we broke down the hidden IRMAA trap. Remember the 2-year look-back rule. Any large financial move you make today will echo into your Social Security checks 24 months from now. Monitor those IRMAA cliffs like a hawk, and if you experience a work stoppage or the loss of a spouse, immediately file Form SSA 44 to appeal the surcharge and protect your monthly deposit. Navigating this system is incredibly stressful, and you should not have to do it alone. The rules are obscure, they are punitive, and they lack any common sense grace period for honest mistakes. But by understanding the mechanics of these traps, you take the power away from the bureaucracy and put it back into your own hands. You earned every single penny of those benefits through decades of early mornings, long commutes, and hard labor. It is your absolute right to protect it from these silent drains. I want to hear from you. Have you been caught by the Tax Torpedo or shocked by an unexpected IRMAA surcharge letter in the mail? Did you have trouble getting the correct survivor benefit when a loved one passed? Comment your experience down below. Sharing your story not only helps validate what others are going through, but it might just be the exact warning someone else needs to hear to avoid making a costly mistake. Let's help each other out in the comments.